Hey everyone, welcome back. It is Michael here with Offshore Citizen, and we're going to talk today a little bit more specifically. We're in, the time that I'm filming this is, I think we're on April 2nd or something. I lose track of days. It's one of my disadvantages. But anyway, we're going through this lockdown period and the stock market, which we're going to talk about today. We're going to talk about investing, like what are some, and we're going to get more specific than I have in a previous video. So the market, talking about the Dow Jones, has gone from around 29,000 down to just over 18,000, then back up to around almost 23,000, and now we're down to around 20,000, and we'll see what happens. The crystal ball, as always, is broken, and predictions are quite difficult. However, I think that there's a lot that we can pay attention to, and some fairly reasonable bets that we can make. So a lot of people are asking me, what am I investing in? What am I looking at? Etc. In a previous video, I talked about kind of watch lists. I can tell you that when the market was around 18,200, whatever it was, something like that, it was feeling like things were pretty cheap, and there were some good buys, and some people made some purchases, and you could have done 100% return on your money on a few of these if you just bought then, rode them up over the next few days, and then sold out, and you could catch it again. So there's great opportunities right now. Options, the spreads or the premiums you're going to pay, the implied volatility is way too high to make it easy. There was a famous trade that Bill Ackman did like a few weeks ago. He invested, I think it was like $27 million and made $2.6 billion. So, out of the money puts, betting on the end of the world kind of thing happened to pay off in that situation. Very difficult to do that at this point in time. The VIX spiked, it's, kind of slowly coming down. So, that whole thing is, so I'm looking specifically at equities. Oil had dropped a ton, and oil kind of had a little pump here, I think it was today. I'm not really big on doing commodities as an investment. If you have the skills to do the trade futures and things like this, great, good for you. But in general, in the macro, some people were asking me, hey, what do you think about gold and silver over 2 years? I had a client reach out to me about, who was has some connections with Australia, so, should he have bought Aussie dollars? And I think these things are not really great ways, they're not really real investments, okay? So Warren Buffett would certainly tell you they're not investments. I would say at this stage of the cycle that we're at this point in the market, the optimal place to be over the next couple of years is going to be equities. I think that you're probably going to do better in equities than you're going to do in gold or silver. You're probably going to do 100% going to do better than that than in currencies, assuming you buy the right equities, right? And probably much better than in bonds, in spite of the fact that the government's putting a lot of money into, or the Fed, I guess, is putting money into quantitative easing. We're having global quantitative easing. In spite of all that, equities, I think, is where it's going to be at. Okay, so if you're not buying equities, whether it's today, whether it's a few days from now, whether it's, a month from now, the exact timing of where the bottom will be, or whether it was, whatever it was a little over a week ago, whether that was the case or not, isn't so much material. The important thing is that you're seeing some assets that are really massively on sale, and when things drop really aggressively, you tend to get we already saw a little bit of a rebound rally, right? And so we're likely to see that over the next little while. So I'm going to share with you my philosophy on what I'm looking at. This is not necessarily the philosophy for everybody. I'll give you a couple other philosophies to pay attention to. And then I'll dive into some really specific stocks and my thoughts around why we're looking at those specific stocks. Okay, so first of all, in my opinion, when you're in this type of a situation, if you were to go back and look at 2008, if you were to go back and look at, I think it was August 24th, 2015, when the Chinese market dove, and you saw, when you see these sharp drops, you're not playing for little gains, okay? Playing for little gains is generally a bad idea in that situation, in my opinion, okay? Right now, we're looking for big gains. If you had bought at the bottom of the market, I mentioned previously, I think, in another video, if you had bought Carnival Cruises at the bottom of the market and rode it up over 9 years, you made 20x your money. So just to give you some context, Warren Buffett's rate of return was about 10x in 10 years, consistently over about 30 or 40 years. So you're doing double Warren Buffett at that point in time. If you had bought United Airlines, bottom to top, it was 30 times your money. You're doing triple Warren Buffett. Turns out the best thing you possibly could have bought that I can find, okay, so all my research, everything that I've looked at, United Airlines and Carnival beat Nvidia, they beat Tesla, they beat Microsoft, they beat Google, they beat Facebook. The two that kind of stood out, so Amazon about matched Carnival. It was beaten by United Airlines, interestingly. Netflix also did extraordinarily well, so you could have done that. The big thing that beat all of those, hands down, was Domino's Pizza. If you bought Domino's Pizza from the bottom to the top in that area, it was 100x your money in less than 10 years. So, you did extraordinarily well if you did that. I don't know exactly how that worked out. I did not have the foresight to do that. I didn't know nearly so much back then. So anyway, this is an interesting opportunity, knowing more to be able to make, hopefully much better decisions. But the point is, I'm looking for things that are going to grow a lot. And there's more or less two types. If you study history of markets, etc., you're generally going to find that two types of assets perform very high returns in relatively short periods of time. Okay, so the first are companies that were very high growth coming into the decline, and their price was slashed because of the fact that the market in general went down. So a good example of this was Apple. In kind of 2007, they released the iPhone. You had going into 2008, you saw a drop in their, I think it was about a 50% drop in their stock price, but they were on this upward trajectory. They very quickly came back, and they did obviously very well, right? So that's one type of company. If you can find those companies that were on a very high trajectory, they have long-term growth potential, and it's a very rapid growth potential. In general, those companies tend to perform well, but you kind of get this added bonus, okay? Perfectly reasonable way to go. The second alternative are companies that were simply decimated, right? So if something drops 30%, I'm really not excited by it, because my basic thesis is that in a good scenario, it's going to return to the previous high. So unless I have a lot of growth lifting it up, I'm generally going to say, okay, we dropped 30%, I'm going to come up 30%, right? Now it's a little bit better than 30% because if you run the math, let's say you went from 100 to, let's call it 66.6, right? Then it's actually 50% upward to go back to 100, right? So, okay, you got a 50% return. It's okay, but it's nothing stunning. By contrast, if it went from 100 to 20, so it was an 80% decline, then in theory, the theoretic upside is back to 100. That's a 5x return. Now, even if you don't do nearly that, right? Let's say you go from 20 to 40, you still did 100% return on your money. So I'm much more interested in those ones that are decimated and have this, they're dramatically oversold. There's a lot of pessimism in the market, and they rebound. Now, the flip side of that is that you're typically taking on quite a bit more risk because there's probably a reason that they're going down. I'm going to go through a really specific stock with you later on where we'll discuss it, and we'll talk about how much does it make sense, right? To kind of illustrate that. And what I want you to pay attention to here is less about the particular stocks that I'm going to talk about and that I'm looking at and going to be investing in, and based on the right price and things like this, and more about the thought process behind it. So just realize that the underlying thesis I'm approaching it from is in these types of times, we're going for multiples on our money, not double-digit returns. We want triple-digit returns, not double-digit returns in cases like this. This is potentially the buying opportunity of a generation. Now, you might have said that in 2008 as well. So, you got two buying opportunities of a generation. But realistically, there's a big opportunity there, okay, from a down standpoint. I mean, we have billion-dollar companies, multi-billion-dollar companies trading at less than 3 PEs, in some cases less than 2 PE, which is ridiculous. That's what you would pay for, in fact, you'd probably find it a hard deal to get a $1 million company for a 2x earnings, okay, in a normal situation. Now, that's trailing 12 months, and earnings are about to get decimated, so, it's not quite so clear. But just the stability, sometimes we're talking about, again, deca-billion-dollar companies that are trading very, very well. So that's a great opportunity, okay? A few other strategies that are worth looking at that kind of fit into a similar thing. If you follow the Ben Graham formula of buying companies that are trading for less than net current asset value, that tends to be a very good deal. I think it was in 2009, a friend reported that those returned about 130% that year. Now, again, it depends where you're picking from. Is it from the trough? Is it from the start? Is it, where is that? But 130%, not shabby returns. So it turns out there's a bunch of stocks that usually they're small cap stocks. A bunch are in the staffing industry. So for example, Kelly Services, I believe it is trading at below net current asset value the last time I checked anyway. So, there's some opportunities that those are very, very rare. Okay, just to give you some concept, basically you can't trade with that formula in the modern day because those stocks have all been picked up. Like everything's more expensive than that normally. So when you have an opportunity to do that, now granted, it's entirely possible that there's negative earnings, and so as a result, it's going to erode their asset base. So there's some research to do there. But if you pick the right ones, by the way, I think that was the whole basket as a whole on average. So if you diversified between them, you got 135, 138%, something like that. You have to look at the numbers, but quite a good return. If you picked specific ones, so you kind of tried to eliminate some of the likely losers, you would have done even better. So, maybe 200% in a year or something like that. Great numbers, okay? Another thesis, this is not a thesis that I am interested in, but some of my clients, some of my friends, et cetera, are into this, they're looking more at what are those long-term companies that are going to be less affected by the downturn right now, and they have long-term growth potential, okay? So let's start with those ones. I mentioned, net current asset value. You can look at Kelly Services, and you can look at, there's probably like 30 or 40 companies last time I did a check. So the market cap is less than net current asset value, okay? If we look at, some of these other bigger, longer term ones, we see things like Amazon. Amazon's really not negatively affected by this whole thing for obvious reasons. Realistically, Amazon is a great company. It's very well managed. It's got solid long-term growth prospects. It's not going anywhere. They've got a great business. That being said, why am I not interested in them? So why I'm not interested in them, and I'll probably do another video on kind of some of investment criteria, but I pay quite a bit of attention to market cap. And so if you think about this, the biggest company in the world, basically, is Saudi Aramco. I don't know what has happened to their shares recently, but they were around $2 trillion before all of this, okay? That's the biggest company in the world. Until like a couple years ago, there was no public company worth over $1 trillion. Apple was the first, followed, I think, by Amazon, and then Google and Microsoft. So you had those $4 trillion companies. Saudi Aramco did their IPO afterwards. So you just think, can that company double in size? And over what time period, right? Because I'm just trying to calculate my target rate of return. I'm saying, okay, well, if I want to make 5x on my money in 5 years, then that $1 trillion company theoretically would need to go from $1 trillion to $5 trillion. Is that at all reasonable? Now, it's basically not reasonable. It's basically not going to happen. The problem is it's simply grown too big to maintain those really fast rates of growth, okay? So I'm not interested in that. So for me, although Microsoft is a great company to own right now, right? Because they've got subscription revenue from Microsoft Azure, that's going to continue. It's mostly you're talking about business, like mission critical software. It's not like you're going to cancel your hosting or cancel your email accounts or something like this. You may be reducing your staff count, so there may be fewer licenses that you're using. But then again, on the flip side, a lot more people are signing up for Teams and things like this. I think they increased, so they have 40 million now subscribers, and they increased by 12 million. So very rapid growth because of this remote work thing, right? So there's some positive forces on Microsoft's business model. There's a few negative ones as well, but generally speaking, it's positive forces. That's going to work out quite well for them, right? You could look at Apple is maybe a little bit more negatively affected than Microsoft and Amazon. You can look at Facebook, again, a little bit more negatively affected, but very solid company. Google, very solid company. I would love to buy Facebook. I would love to buy Google. I would love to buy NVIDIA. I would love to buy Netflix. I mean, any of these companies that have a very solid business, that they have competitive advantage, long-term, they're great. I'd like to get them at a discount if I could right now. I just noticed that they just don't decline enough. And so my upside is 30 to 50% or something. Even if they have a little bit, their earnings are growing and things like this, it's just not that exciting for me. But those are some examples of the types of companies that, if that's your philosophy, if you're saying, hey, look, I don't know what timing is going to be the best time to buy in, so I just want to buy a solid company. I already know that shares are down, 20, 30% from what they were before. So, some of my downside is already taken away. I'm going to pick it up, and, hopefully I'm holding it for 5 or 10 years. And I may not get great returns, but I'm probably not going to get decimated either. And so it's a safe investment. So perfectly fine, right? Perfectly fine way to go. As far as I'm concerned, anything retail is not a good way to go. You have obviously right now everything's bad because it's shut down, but the retail trend in general is going down. Maybe if you pick up, Zara or something like this, then that could be okay. But, I look at Nordstrom's, Macy's, companies like this, and as much as I would like to be able to say, hey, I'm interested in those because they're trading at a very low PE, they're at, 5-year lows, sometimes, 10-year lows or whatever, I'm concerned that they're just generally not stable. And so by the time they recover, it'll go down. So this is a basic concept as well. Again, I'll probably do a video where I discuss kind of some of the fundamentals of investing from my perspective. There's many ways to skin a cat, right? But I figured, okay, the company, let's say their value is here, they're going to drop down, their price drops because of what's going on down to here. I'm looking for them to recover to their value, whatever the value happens to be, and it's going to happen over a certain period of time. Well, if their value is declining, then by the time they recover, right, they may not be much upside in it. So I don't want anything where the underlying value is declining over time. I want something where the value is going up and the company happens to be way down. That's like my ultimate goal, okay? So now let's shift from there into kind of what might be an Apple-like stock, right? So if I sit back and I say, okay, Apple in 2009 was a great buy. It was this high growth company that dropped and then continued on. What would be a company like that? I'm interested in Beyond Meat from that perspective. It's far from a sure thing, but there's a few things that I notice about it. Number one, so it's growing at like 212% a year, or that was the last 12-year numbers. They have quite a unique product. They have quite a low market cap. It's about a $4 billion market cap. So I just, again, asking myself, well, what kind of growth potential is there? Could that be a $40 billion company? Absolutely. I think it could absolutely be a $40 billion company. Could they have competitors? Yes. There's all kinds of stuff that could happen. But what I've noticed is that in general, the market doesn't do a good job of pricing in extreme growth. What I mean by that is the theory, like efficient market theory, is supposed to say that, hey, look, if it's growing very fast, the price is going to be so high, the multiple you're going to pay is so high that it accounts for that growth, so you don't end up with an advantage over buying something that's slow growth. So let me give you a specific example of two companies. You could have bought, say, Bank of Nova Scotia, right? Very solid company, but a company that's not going to grow much over a long period of time. So you'd probably expect, I haven't done the analysis recently, but the last time I did it, I kind of estimated about an 8% a year compound annual growth rate, okay? So 8% a year growth, nothing crazy. At the same time, if you were to go back to when Facebook went public, so say we were looking at that same time period, Facebook came out at 100 times multiple. Now they dropped off after their IPO to about 60 times, right? And then, they dropped to about 60% of their IPO price. Their earnings were kind of fluctuating in that period of time. But the whole point is, you might say, hey, well, you've already priced in, whereas Bank of Nova Scotia would be priced at about a 10x PE, right? Facebook was priced at 100 times PE. So you say, well, that's already built in the tremendous growth. Well, the truth is, you can go and look at the stock. The amount of growth that happened in the Facebook stock, in spite of that high multiple, it was still a far better investment, okay? Just far more upside. And I've noticed this pretty consistently. Same thing with Netflix, right? They were at 200-300 times PE, and they still outperformed everything else. You can look at a bunch of these others, and video is something similar, and so on and so forth, right? So when you're in this ultra high growth rate, as an example, well, Apple was the same. Apple was doubling year over year, and you might say, okay, well, they were priced for it. They had a forward-looking PE that they priced based on this growth. but you know what? It's still outperformed. So that's usually even at 100% a year growth. When you're talking 200% a year growth, that's insane. The market, if you sustain it for any length of time, the enthusiasm that kind of roils from it just pushes the stock price up a lot. And so from my perspective, Beyond Meat is now lower than their IPO price. Basically they IPO'd last year, they exploded, then they kind of pulled back, and then pulled back further. I think that it's a very interesting company as a possibility to buy. I wouldn't put my entire portfolio in there. I'd probably do it somewhat strategically. I plan on it being a fairly long-term buy and hold, but I think it's a very interesting company that fits that criteria. And I don't see a lot others like it. One that people are talking a lot about is Zoom. I did a pretty detailed analysis on Zoom in an investment group that I'm in. And the way that I look at it is at $15 billion market cap, it was probably a good buy. At 30 billion, it was, not really so much. It's gone up to 45 billion. It's pulled back a little bit now, but $45 billion market cap is no longer a good buy. And the reason is just, you can think, like, this is fun. I mean, we could go and we could look at, how the earnings are growing. It's a great company. Like their customer acquisition cost, relative to their lifetime value and things like this. Great company, they have a nice business model, it's well managed, they're growing fast, all these things. But how big can that company really get? Salesforce has a $120 billion market cap approximately, serves a lot more people, does a lot more. You're talking about a company that does video conferencing in a very competitive space. Okay, so you have Blue Jeans, you have Microsoft Teams, you have, somebody showed me today, Demino or something like that, they do webinars, things like this. Like, it's a pretty competitive area. And, how do you differentiate? How do you maintain that? How do you, how many people are gonna pay and how much are they gonna pay? I just don't see them reaching, say, $120 billion market cap within, let's call it 5 years. Well, to do that, if they did that, if they reached $120 billion market cap, I don't think they'll make it there in 10 years, to be honest with you, just because of the nature of the industry they're in. There's just limitations on the market size. And they're way, way, way below, their earnings would have to grow at an astronomical rate to reach there. Well, that's 3 times your money. 3 times your money in an environment like this is not that good. So I think that at this price anyway, it's not a great deal. I don't expect that they'll drop a lot because there's a lot of enthusiasm for them right now, just due to kind of this social distancing, etc. So I doubt there's going to be an opportunity to buy. If it drops down to $15 billion market cap, I would buy. Okay, so that kind of tells you something there. Now let's talk about some of the more decimated. Well, actually, before we go on to those, I do think that Royal Dutch Shell, I mentioned it previously, it dropped down to about $26 a share, something like that, maybe $23 a share. It's come up a lot. It's a great opportunity. Some people bought in and have done well, so kudos to them. The dividend payment had risen to about 15%. Now, I wouldn't expect them, although they have a 70-year dividend history, I wouldn't really expect them to maintain this 15% dividend. They were first brought to my attention by a good friend who, is a great investor, very, very excellent. And so kudos to him. Thank you for doing that. That's Tio. So appreciate that. I think they're a very interesting company to buy as a stable, long-term company that has had their stock price beaten way down. They were trading in a range from about $40 to $80. And you go down to almost $20. There's a lot of upside there. The oil industry has been beaten down. There's enthusiasm on that side. It's a profitable company trading at a low PE. I like that. They have a 70-year dividend history. They're about 170, I think, when I originally looked, but somewhere around $150 billion market cap company. They're involved in refining, not exploration, so things are good in that sense in terms of greater stability. So that's a very interesting company if you want to go and look and say, hey, what can I buy right now that's a low-cost, high-dividend stock that I can buy and hold it as part of my portfolio for the next 5-10 years, probably get a bunch of cash flow off it, plus some growth. That's, I think, an interesting one. In terms of what we're looking at for ones that are decimated, I think I mentioned previously, I think tourism-related companies in general, this comes from a bias, and maybe I'll do a video on it in general. If you have something you want to see, please, mention in the comments, email me, something like that, subscribe, like whatever it is. Do something to let me know, and I'll happy to really, do some more videos on that. I'm very bullish about tourism over the long period of time. So this rising tide raises all ships. I'm interested in a company that the company itself is gaining market share within the area that it's in, and I want a growing market. If I have those two things, that's great long-term fundamentals to me. And I just say, hey, the population is rising, the demographics are such that people are becoming wealthier, and so you're only going to have more tourism. And so if I have companies that can capitalize on that, I like that. This obviously would mean hotels, it means cruise ships, it means airlines, it means restaurants, it means potentially theme parks. Those are kind of typical areas to look. Within there, the other thing that I would say is, well, I am interested in video gaming. I think that's kind of similar demographic trends, but I haven't found the good deals there. So that's another thing that, yeah, right now it's not really for me. But I think long term it's a great industry. And then clothing is kind of the same idea. We've seen, this rise of fast fashion. Over the last few years, we've seen a tremendous surge in luxury fashion. Luxury fashion, unfortunately, hasn't dropped enough to justify it, and going into a kind of a global recession, which is very, very likely at this point in time. Probably people are going to be spending less money on that. So I don't see their opportunities being in there. But some fashion potentially is great because more and more people are going to buy clothing, and they're going to buy more clothing. That's a trend that's going to increase. Like right now, we've already seen it in Europe, in North America, in parts of Asia, China for sure. Well, as India, as Africa, as Latin America become more and more affluent, you're just going to see a growing trend there. And there's a lot of consumption, which is going to drive a lot of sales. And it's a pretty scalable industry. So I like that a lot. It can be driven kind of by brand, et cetera. So again, very, very good for profit margins. And so, yeah, those are types of companies that I'm interested in. So looking at specifically some of these, the airlines I think are very interesting, specifically the US airlines. And in my view, the airline that I'm most interested in is Delta. I think Delta as a company, if you kind of look at the fundamentals, they tend to be better than some of the other major ones. You can look at something like Southwest. The problem is Southwest was simply not beaten down far enough. So right now, I think I was checking earlier today, Delta's like around a 3x multiple. The good thing about the airlines is they're backstopped by the government. The government's already authorized a bailout for them. So the risks are very, very minor. We might mention that in there's also Airbus and Boeing. Airbus had gotten really taken down, then it kind of came back up. So there was a good buying and selling opportunity there, short-term trade, and now they're down again. So they're down to their lows. You just think about this. There's basically two companies. Is air travel going to go away? Not at all, not at all. There will be more air travel 20 years from now than there is today. There's basically only two companies that make aircrafts for that. They are Boeing and they are Airbus. So, is there going to be more sales? Probably. And so as a result, it's a pretty safe investment if those companies are beaten far enough down. I think there's some great buying opportunities there. The recovery will probably be slower than airlines, but nevertheless, I think there's a decent upside there. So those are worth paying attention to. So if we go back, we say, okay, they're backstopped. United, American, and Delta, all three to me were beaten down more than say JetBlue, than Southwest, et cetera. I don't really trust the airlines in Europe. The airlines in Asia I had kind of more issues with, et cetera. So to me, it was the American airlines that were interesting. And I think that from a competitive advantage, return on equity and things like this, underlying fundamentals, operating margins, et cetera, company, growth of market share, et cetera, Delta is, to me, the more interesting one. So that's the one that I'm most focused on. That being said, I'm paying attention to all of them. And I think that most of the time, the sector is going to, you're going to find there's a lot of correlation on the returns within the sector. So probably, if you buy any of them, you're unlikely to do badly, provided you buy at the right price. But, something to be worth considering. This brings us to cruise ships. So here's where I wanted to talk about the risk of bankruptcy. So there's three major cruise companies you can look at: Norwegian, Royal Caribbean, and Carnival. Carnival was decimated today. They're down. They have not been this cheap since 1992. So if you just think about that, that's pretty crazy. What's the problem here? Well, the problem here is the government hasn't authorized bailouts for them yet. There is some talk about it, but there's also talk about Carnival being excluded from those because they don't pay taxes in the US. So bad sign for them. They've gone to the debt market. So they carried, around, I think Norwegian carries about 7-point-something billion in debt. Royal Caribbean carries something like 13 or somewhere around that billion in debt, and Carnival is slightly more than that. The largest is Carnival, then Royal Caribbean, then Norwegian. That's a really big problem. Okay, that debt. First of all, they're basically going to default on their debt payments, barring some other form of financing. Okay, they have, as an example, Royal Caribbean had like around 250 million in cash, and their debt payments for the year are 400 million, and their season is gone. Like, they will lose a tremendous amount of money this year, guaranteed. Guaranteed they're going to lose a lot of money this year. And so that's a problem, right? So, they need cash to get through. I think it was around $11 billion that Carnival just raised. And some of this is very expensive financing. They managed to raise, I think it was 6-point-something billion at 11.5% interest rate. The rest was at like 5.7 or something like that. This is expensive money. This is going to be something that's going to weigh down their earnings for quite a few years. They're going to have, they're going to have debt repayments, and they're going to have debt servicing costs. That's going to hurt them quite a bit. It's going to prevent them from making capital expenses in order to expand, provided they can get through it all. So I am watching, because I think that if you reach a point where they're sufficiently beaten down, right? Their price is so low, the market thinks they're going to go bankrupt and they don't go bankrupt, there could be a nice pullback there. That's a really tough trade to make. Like, you have to be very, very on that. You want to practice proper risk management, things like this, but there's a possibility there. So I am watching that. That being said, financially, I think Norwegian is in the best position right now. I'm still looking at Royal Caribbean as well. Like, I think they're all three interesting in this respect. And, purchases will be based on the timing and, what happens with the price, etc. But it's something definitely worthwhile. Just imagine this. Imagine that Carnival doesn't get bailed out, but the other two do get bailed out. Basically, Carnival's the biggest. You're talking about an enormous amount of market capacity that could be absorbed by this. There's a lot of growth potential. Their assets get sold off. Now, how they get restructured and what goes on, probably they don't go to, you probably have a new company birthed out of that. But there's the potential to seize a lot of market share there. And that's very, very interesting. So something worth considering. Restaurants. I've noticed that a lot of restaurants haven't been taken down as much as I would like. So that's not so great. My friend Jason suggested looking at Cheesecake Factory. I have done some research on it. Strong fundamentals. It's been beaten down. It's quite interesting. Jack in the Box is an interesting one that I'm looking at. And there's a few others. The big ones, Starbucks, McDonald's, Domino's Pizza, Papa John's. These ones that have high delivery businesses tend to be less interesting. Somebody was mentioning QSR to me. That's the company that owns Tim Hortons and some others. To me, good company in a lot of regards. You can see a general upward trend. Their growth is not so great, but their return on equity is not bad. They're profitable. So, these things are fine. The challenge to me is, again, they just haven't been beaten down far enough. If they get down far enough, I'm happy to buy. I think that they're very interesting. There's a few others you can go and look at, Dine Brands, Bloomin', BJ's. There's a few others. Anyway, I would go through the restaurant area and do your own due diligence. Again, I'm looking for these ones that are down 75, 80%. Really, I want 80%. I'd love if I could get 90%. That would be fantastic. That'd be great. But we'll see where they go. Those are some things that I would be paying attention to right now. Some others that you might look at: Six Flags theme park is down a lot. SeaWorld is down a lot. Not exactly the same, but Live Nation was really beaten up badly. You can look into the hotels, Marriott, Hilton, and some of the others, as well as the Las Vegas casinos, so Wynn, Sands, MGM. One of them was Tropicana. Anyway, one of them had their assets bought. These are some of the things that I'd be paying attention to right now, and take a look and see what you think. Follow the price action. Though, if you're good at it, and if you're willing to kind of exercise proper risk management, etc., there's a lot of money to be made right now just in catching the variations in price. You could have easily made 100% so far, which is great. So anyway, I hope that's helpful. If you have some specific ones you'd like to ask about, reach out. Look forward to seeing you guys on the next video. If you like the video, subscribe, like, and we will see you soon.